Hello and welcome to Internet Capital Markets, the weekly show where we explore how financial systems are being rebuilt on the web. Each week, we sit down with the builders, investors, and institutional leaders shaping this transformation, from tokenized assets to decentralized finance, dApps, and everything in between. Today, we focus on security, an essential topic, and we brought an old friend. But before that, let me welcome my co-founder, Jonas, as we are building smart treasury for Internet Capital Markets.
Welcome, GM, I guess. So really looking forward to our guest today. Like you said, he is an old friend. So he's like following our journey, I think now for more than 2 years or almost 2 years. And yeah, we always meet each other on like different occasions, different conferences. I think right now he is also on a conference that is like starting or is like currently happening. Maybe he can talk about that as well. But yeah, welcome, Philipp Fritsche from Oak Security.
Hey, many thanks for being on. It's a pleasure, as always. And yes, I'm in Buenos Aires. DevConnect will start very soon. And yeah, but like everybody's already here and meeting up. So that's what I'm doing as well. Happy to meet you guys.
Buenos dias in that case, I would say. So yeah, Buenos Aires, wonderful city. I lived there myself for a couple of years in my past, so always like worth a visit. You have an extensive background and a really interesting background, especially like for someone working in Web3 security. So your background is like in economics. You also did your PhD in economics, and now you're working in Web3 security. And what I always like find super interesting about you is that you are not only looking at the code like from a computer science perspective, but because we are also in DeFi and this is like related to economics to some extent, and hopefully you can elaborate on that. You also, when you do reviews, you also look at it from a economic standpoint. So maybe before we dive into the nitty-gritty stuff here, for everyone who's not familiar with you and with Oak Security, maybe you can introduce yourself and talk a little bit more about Oak and your journey now, like being an MD at Oak, and also about Web3 security.
Yes, okay, many thanks. You almost said everything already, so I think I can be brief there. I am a former central banker who turned into a Web3 auditor. And yeah, my specialty used always to be economic exploits or economic ways to extract value out of Web3 protocols. That's what basically, that was my angle into Web3 security. And now I run a cybersecurity firm. So we do much more than economic security. We do classical audits, pen tests, but also infrastructure and virtual CSIO services. Yeah, happy to be on. The name of the company is Oak Security.
Super cool. So our show is called Internet Capital Markets, and our strong belief is that at some point the entire financial industry will move on chain. This is like our big bet. That's why I built in this space. That's why I truly believe that this space can be super big. But from your perspective, like what role plays security here? Like especially when we are talking about like financial institutions, traditional finance is moving on chain.
I mean, cybersecurity is very, very important. We see that like every day in Web 2, data gets leaked, data gets stolen. We see these big exploits. But when data gets stolen in Web 3, that means it's not that your credentials are a threat or somebody might have access to your health records. It's really that your money is gone, right? So in Web 3, exploits have a way stronger impact, and depending on the specification or depending on implementation, actually, these things cannot be rolled back. And also, I always say this, but I have to say this again. We empowered the user in Web3, and users are not the best when it comes to making security decisions. So we have to manage that angle as well. And in a way, that's new, but in a way, it's also old, because before, like, we had big banks basically running the whole financial system. The whole money economy was based on safeguarding your own assets, and maybe we are moving again in that direction. And that's the direction that I think many of us Web3 native people are already used to.
That's super interesting. Yeah, we're moving into that direction, and actually on that, we often hear that all those projects, protocols, how we call companies here in the space, is actually battle tested and audited. Sometimes they collected 3-4 of those badges. From your perspective, how do you define real security maturity in Web3?
So security is not a label, and I think, like, we cannot say this often enough. Security does not mean audited. Audited does not equal security, and security is a living process. And like, most of the things that you can do to secure your project can be done in-house. Like, an auditor is there to make sure that you've done everything correctly and help you with the last kind of maybe 20 to 10%. But it starts with the architecture. And, like, especially we have now shifted very much on, like, trying to get that message to our clients. And I'm glad that it is well received, that you should start earlier thinking about security. And we offer a range of services for companies to attack security early. But still, like, you have every Web3 project has to realize that they are building financial software that is more exposed to hacks. And you have to slow down, and you have to be very careful. And I think this is the most important part. Test internally, set up monitoring instruments, and also plan for the worst case. Right? It's not like a hack might always happen, and you have to be prepared that a hack is a bad day and not the last day of your company. So you have to have an incident response playbook ready, and all these things, right? They are super important. And audited is not the end of the ladder, so to say. Yeah.
It's a start. It's an ongoing process, as you say, and it's about preparation. Now, what we're seeing, like what's happening in the markets, is that institutional capital markets are merging with internet capital markets, so everything is moving on chain. And if we imagine a world where $1 trillion asset classes live fully on it, what do you think or believe is the minimum security requirement we must reach, both technically and organizationally?
So on the organizational front, I think there's still a lot to do, especially when it comes to more centralized entities moving on chain. Because at that point, the human factor plays an even larger role. And this is typically the weakest link everywhere. I think, in a way, I feel Web3 is ready for mass adoption, also from institutions. But still, there are some missing pieces where I think if we had them, then this would supercharge Web3. Like, and I'm thinking of the catastrophic events. Imagine, like, now, today, NASDAQ is moving on chain, right? Every asset is living on chain. And then suddenly this thing gets hacked on Ethereum or Solana. And now, I don't know, 30% of NASDAQ, including the real estate or whatever else is in there of the companies, is suddenly owned by, I don't know, a nation state threat actor. And then what are you gonna do, right? Is it like, okay, they just everybody is gonna say, oh, we have to roll that back, right? And that will happen. And anticipating this, I think we have to set up some kind of centralized entity. I guess it needs to be a supranational entity to have some kind of say, like something like the Basel Committee when it comes to banking regulation. We need to have some kind of international committee that is able to resolve these kind of issues, because there will be a social consensus layer that will oppose these things happening. Like if that happens, I think like not none of the, even not the super decentralized maxis will say, well, but now give Nasdaq to, I don't know, some nation state hackers. Like that's not gonna happen. So anticipating that and yeah, making sure that we have a process set up for this case is, I think, something that could supercharge Web3.
These were some spicy takes, I guess, for
Yeah.
for especially like the decentralization maxis, I guess. But you also mentioned, and this like really caught my attention. You mentioned that Web3 or the technology is like ready to actually used also by traditional finance. Now, the other day we all saw the news again, like there was like a huge hack going on. Balancer, one of the oldest and also one of the most successful DeFi protocols, got hacked. I think more than 120 million US dollars were drained. And I mean, people, when they see that, and if they're not familiar with the industry, they get scared, right? And do you still, or would you still argue that on-chain finance can be safe enough so that everybody can trust it, even though that you don't have like this expertise, like on the one hand side, on the personal level, like for the everyday user, but also on the institutional level?
No, I think like this is what I mean. I think on the operational level, we have still to mature, but I think the technology in theory is ready, right? I think the balancer, and I cannot speak about the balancer exploit because we haven't seen the full postmortem yet, and I don't want to get involved into a hack that I wasn't kind of involved in professionally. So, but I would say, okay, bad things can always happen and can still happen. It was a very bad incident, but I also would say it wasn't one of the worst. And like the great thing about hacks like this is that I think they reveal what we have to improve. And I'm looking forward to see the postmortem. From my perspective, I think a lot of what would come out there is that the operational side and the incident response side could improve and could be better. But as I said, like as this is an ongoing thing, I don't want to, like have any strong opinion on that at the moment.
Yeah, I think that's fair enough. Shifting gears a little bit. So you're also like quite familiar with like regulation in crypto, and I've read your articles on various occasions, like over the last couple of weeks and months. Also, you have worked for a central bank, for the ECB, and we all know that stablecoins play a huge role in on-chain finance, obviously. And from your perspective, maybe also you can give a little bit more insight about like the European perspective and the European chance here. Like, how should a smart stablecoin regulation look like so that stablecoins can really truly unfold their potential?
Actually, I'm that enthusiastic about this topic that I started my own podcast about this. Like we are discussing a lot with central bankers, and one of our future guests will be the guy who is basically behind the digital euro. My co-host is also a head of a central bank, Meta Markets, and is the name of the podcast. And my perspective is really that Europe needs to catch up. The European stablecoin legislation comes from a time where Facebook set up Libra, and the threat was that they basically take over the European market with their stablecoin. And back at that time, the US ruled out any kind of legal stablecoins, basically. And now, like the picture has changed fundamentally, like really complete turnaround of this of the regime that we are in. And I think the Stable Act and the Genius Act, they both are very great legislation when it comes to enabling the US exporting the dollar and making people buy US treasuries in order to facilitate basically low interest rates in the US. And the European stablecoin legislation basically requires you to go through banks as a stablecoin. And this defeats the purpose, right? It makes it very hard to, first of all, run a profitable stablecoin. And it does not add competition to the banking space, but it further cements basically the monopoly that banks have. And I think this is really not a great act in that way.
I share your opinion, and with your background and actually being so passionate about that, starting your own podcast with that, let's talk a little bit about the regulational approach and the so-called dual issuance model that actually stablecoins should avoid, or ECB wants to avoid that stablecoins are issued abroad and are limited in the European market. From your perspective, what does the ECB really intend with that, having worked with the ECB yourself?
Well, I can't speak for the ECB anymore, and I never could. But I think the intention of the ECB, and like it's very interesting that the ECB has a fundamentally different stance from other European bodies. So if you talk to people from the Commission or the Parliament, they have a pretty much pro-innovation and pro stablecoin stance often. But the ECB is different, I think, first of all, because they want to push their own central bank digital currency. And second, I think, because they have been having critiques of cryptocurrencies in the past, and they are there, and I think like it's good for a central bank to be there as a voice of prudence. However, I think they exaggerate. So what is the problem? The problem is if you have a stable coin in the US and you have a stable coin and you have the same stable coin in Europe and it's legislated under two legislations, then you could basically transfer a stablecoin from the US to a German holder, and then the German holder would be able to redeem that under European law. And obviously, this creates some frictions and some problems, and I believe these problems are solvable. But the ECB wants to limit the power of European stablecoins in a way. And I think the motive there is really to protect the central bank's digital currency and to also protect banks in a way. I'm not sure if they are doing this intentionally, though.
Yeah, fair point. Now, looking at the stablecoin space, there are two different types of stablecoins, those with centralized issuance and those with decentralized issuance. And due to the nature of regulators, they favor, obviously, the centralized ones. Do you think we will also see stablecoins with decentralized issuance that will reach institutions and traditional finance markets?
That's an interesting question, because what are institutions nowadays? If you think of the Goldman Sachses and the Morgan Stanleys of the world, maybe not.
Yeah.
But crypto itself has produced institutions, right? There are big funds that only consists of crypto assets, and those funds, they trade these stable coins, they use these stable coins. And I think those institutions that are already a little bit detached from nation states, they will maybe embrace decentralized stablecoins. But other than that, I think the majority of the larger institutions that we think of from traditional finance, they are unlikely to engage with any of that, just to avoid legal trouble, or they're going to be the last movers, right?
Yeah, that's a very interesting thought. And I feel like there are more and more like tries that institutions undergo at the moment, especially with the regulation now coming up in the US with the Clarity Act, for example. We also see like major players like staking providers also launching earn products. So really direct access for institutions to the DeFi world. But if you're like thinking a little bit more about stablecoins, because they are like so central in a way, because you can settle in them, you can always like invest and withdraw from DeFi protocols and then go back to stablecoins. And our vision is also like a little bit that at some point maybe companies only hold stablecoins only hold stablecoins, because it's like just a more functional way of like dealing with like transfers, transactions, and so on. But like from a risk perspective, where do you see like the biggest risks for stablecoins? Maybe you can touch a little bit on like smart contract failures or collateral risks, regulatory intervention, depegging. Like, what is your stance there?
So, first of all, you have to differentiate these centralized or decentralized stablecoins. I think for centralized stablecoins, there's a big attack vector we don't talk enough about, and this is just the human in the loop, right? So, for example, USDC, also Tether, they have a blacklist, and somebody controls that blacklist, right? It's admin keys controlling that blacklist. Now imagine somebody just puts everybody on that blacklist, right? So, like this could lead to, I don't know, a 3, a 5, or maybe a week-long outage of some stablecoin. And these stablecoins, they are interconnected. They run crypto, so to say. And a hack like this could have a catastrophic impact, right? This is something that we always have to keep in mind of when we talk about centralization. And I think this is also the biggest critique of my earlier point that I mentioned, that, okay, we need some kind of centralized entity that somehow oversees this, or at least facilitates the social consensus about, potential catastrophic event. But then there is it really also depends on the legislation. For example, in Europe, because our banks are such a critical point in the whole stablecoin infrastructure, a banking crisis would one-to-one translate to a stablecoin crisis. And then on the other hand, in the US, it's the opposite. In the US, a catastrophic failure of one of the stablecoins would likely result in a fire sale of treasury collateral, and this could then spill over into the real economy. So, I mean, it could look like this, right? A big stablecoin such as USDC faces mass redemptions. These mass redemptions, not even caused by a depeg or so, just people wanting immediate access to their money, maybe because of a panic. They could fire sell the collateral, so the treasuries behind them. They could go to basically withdraw their USDC holdings to dollar, and then the stablecoin had to fire sell the collateral behind it, and then we would need a central bank intervention in the repo market or somewhere else to prevent that the US Treasury rate basically skyrockets. So there are this really illustrates how like different regulatory regimes might impact the how such crisis would look like. And I think like one smart contract risk is always that the smart contracts are gonna get hacked. But for stablecoins, the risk at this point is relatively low because stablecoins are very easy smart contracts. When it comes to yield-bearing stablecoins, or let's say stablecoins that are less stable, that behave more like an investment fund or like a trading strategy, I would think of Athena, then this is different. Then I think there is a little bit higher technical risk. But yeah, I think like eventually we will need some kind of macro-prudential policy for stablecoins and DeFi, which again like kind of addresses the earlier debate on what's the international committee or consensus forum or DAO overseeing this, right? It could be a DAO. Then maybe the decentralization maxis would be okay if you call it the Basel DAO of crypto oversight.
Yeah, that would be like very interesting. Like also like who is then the supporter of such a model, right? I mean, I could imagine that many states would be heavily against that. But a very interesting thought. Like you already touched on like the macroeconomical perspective here and the potential risk for or like caused by stablecoins, for example, by such a fire sale of treasuries. Do you see like any other macroeconomical risks here or dangers? Maybe also compared like to normal fiat currencies.
I think what we have to aware of also when we think of these macro risks is that how interconnected the whole system is, right? So, for example, I think that Black Friday, Crypto Black Friday, a couple of weeks ago, showed that, for example, these auto-deleveraging features that are built into the perpetual protocols. So basically, if you trade with leverage on a perpetual protocol, it might be that during a kind of stress episode, these protocols decide to close positions. And this has a strong market impact on other markets, also on spot markets. And eventually this might trickle down to stablecoins, especially those stablecoins that are backed by crypto assets. And we have to be aware of that we have a problem with stablecoins if they depeg in a very small manner, right? So if a stablecoin, I don't know, depegs only 5%, this might already cause some kind of panic. And I think also here there are fixes around this, but we have to implement them. Like the technology is there. And on another podcast, I made the point that, we even have these micro fluctuations in bank deposits, but we don't see them, right? The profitability of your bank where you deposit your money as a normal user, it fluctuates. And if the profitability fluctuates, also the default risk of the bank, so to say, fluctuates. And we don't see that on our bank account because on our bank account, there's no oracle that shows us, hey, you have, I don't know, a balance of $5,000 at this bank. But there's a 0.0003 probability that your bank is going to be bankrupt tomorrow. And in the stablecoin world, we constantly see that number, and this gives us another perspective, or just lets us perceive the risks there very, very differently. And so I think there is on that side is a lot of market expectations and dynamics that we have to manage. That's one of the main macro risks I see with respect to like the DeFi ecosystem and the contagion effects.
Yeah, these are very, very valid points. Also, last week we saw the pegging of one stablecoin actually with the Elixir network. And let's switch gears a little bit and do a quick fire. So I will ask you one question, and you have one word each to answer. Are you ready?
One word. Oh my gosh! Yeah, let's go.
The most overused buzzword in Web3 security.
Audit.
The most underrated attack vector today.
Phishing.
One protocol you consider a gold standard for security architecture.
Oh, I can say gold standard, but I think like one project that's really inspiring is Reserve, because they have a toy model for their real contracts, and that's a great way to educate your own engineers internally.
That's a good one, but was more than one word.
Yeah, sorry for that. I cannot say this is the gold standard. Sorry.
Okay, good. One security myth you would want to kill forever.
Audit.
What is the biggest security blind spot nobody in the industry is talking about yet, but that will matter in 3 years from now?
Macroprudential risk.
Good one. If you could enforce exactly one rule for every founder shipping a smart contract protocol, what would it be?
Flowchart is one word.
Cool. One word to describe the future of internet capital markets.
Great.
Cool.
Yeah, it's really hard, like especially if you really have like so many thoughts in your head. But before we wrap it up, maybe you can tell the people who are watching where they can find you, where they can learn more about you. And last question, who should we talk to next?
I think you should talk to Bermuda next. They enable basically privacy within any wallet, and they are boosting, I think, institutional adoptions more than most other protocols. And other than that, check out oaksecurity.io. You can find me on LinkedIn or Twitter. And my name is Philipp Fritsche. Happy to engage with you.
Thank you so much, Jan, for your insights today, for this great discussion. To all the others, if you enjoyed today's discussion, make sure to subscribe, rate, and share the show. It helps us to bring more conversations with the people shaping the future of internet capital markets. Join us next week as we continue exploring how technology, capital, and human creativity converge to build the financial systems of tomorrow. Until then, stay curious, stay connected, and keep building the future of finance. Bye-bye.
I'm not sure if I'm still recording. I see.